Shadow prices are estimated prices that reflect the true opportunity costs and societal objectives of a project rather than just market prices. Market distortions often hide the real value of a service to the economy. A private owner might ignore them, but the government cannot. In economic analysis, we use these accounting prices to evaluate inputs and outputs accurately. This ensures that every project decision aligns with the actual benefit to society, rather than a distorted market reality.
Net present value, or NPV, is the difference between the present value of benefits and the present value of costs. To calculate it, we discover net cash flows at a required rate of return and deduct the initial investment. A positive NPV means the project is a gain and should be accepted, while a negative NPV signals a loss. When choosing between competing projects, the rule is simple. Always prioritize the one with the highest NPV to maximize value.
The internal rate of return is the specific discount rate that sets the net present value of a project to zero. It represents the project's intrinsic growth rate. To determine feasibility, we compare the IRR with the prevailing discount rate or opportunity cost of funds. If the IRR is higher, the project is a go. If they are equal, the project is at a break-even point, and your decision will depend on other strategic or qualitative factors.
The payback period is the measure of project capital recovery, representing the number of years needed to earn back the initial investment. This technique is all about speed. As a project director, you use this to gauge risk. The quicker the recovery of the initial capital, the more desirable the project becomes. While it does not measure total profit, it is a vital tool for ensuring the organization isn't exposed to financial risk for too long. Cost-benefit analysis is a strategic assessment where different approaches are compared to find the most beneficial path. We identify, quantify, and monetize economic benefits in net present value terms, then weigh them against total costs, including opportunity costs. The goal is to calculate the net benefit of each option. By selecting the approach with the highest net benefit, we ensure that the project delivers the maximum possible value to the economy.
Cost-effectiveness analysis focuses on operational efficiency to find the least expensive way to achieve a result from multiple alternatives. This is your go-to method when benefits are hard to put a price on, such as the number of lives saved by a vaccination program. By comparing the cost-effectiveness ratio of different approaches, we can identify the most efficient route. In this analysis, the preferred option is always the one with the lowest ratio for the desired outcome.
The benefit-cost ratio is the ratio of discounted benefits to discounted costs. While a ratio over 1 is feasible, it does not always show the full scale of a project, which is why we also perform risk assessment. We identify negative threats like delays and positive opportunities like early completion. By planning for probability and impact, we create a risk register that protects our ratio and ensures the project remains resilient from start to finish. Thanks for watching. Subscribe for more.